I've just examined 5,358 publicly listed companies from all over the world so that you can understand what the stock market values in 2023. But first, a little intro. Why should an investor care about this? Mr. Market is an analogy that the father of value investing, Benjamin Graham, invented in his 1949 classic, The Intelligent Investor. Mr. Market is the ultimate business partner. Every weekday, well, almost every weekday, he'll come knocking on your door ready for some trading. Most of the time, he's pretty good at estimating the value of stock market companies.
The market is generally, to me, it's almost self-evident if you've been around markets for any length of time, that the market is generally fairly efficient.
People who think the market is reasonably efficient or roughly efficient, of course, are absolutely correct, and that will stay with us for the long haul.
However, sometimes Mr. Market is euphoric, drunk even, and he'll pay sums that are so large you wouldn't believe it. And at other times, he's all gloomy and tells you that your stocks are trash. But he never forces you to do anything. Mr. Market is a rare person. You can say no to him however many times you'd like, he'll always come back nonetheless. Warren Buffett explains how one can take advantage of this in his 1960 partnership letter. Our bread and butter business is buying undervalued securities and selling when the undervaluation is corrected. Yep, the young Warren Buffett did not hold on to his stocks forever. He bought low from Mr. Market and sold high, and his returns during this period were staggering. If we too want to buy low and sell high, I know, it's so overused that I'm getting sick of saying it, but stay with me. Then it pays to know what Mr. Market likes and dislikes in general. Why? Because if we do that, it'll be easier to identify the exceptions, the times when he's gone a little bonkers. This is the Swedish Investor, bringing you the best tips and tools for reaching financial freedom through stock market investing. Let's start with growth. Do you think that the stock market values a growing company differently than one that is in decline? Absolutely. But by how much, and how should one measure growth? I've tried examining growth for a bunch of different variables and a bunch of different timeframes. Growth in revenue, gross profit, operating income, net income, cash flows, dividends, growth during the last 10 years, the last 7 years, 5 years, 3 years, just 1 year, and this is the general conclusion. Mr. Market thinks that historical growth in revenue is the most important. In short, the further down you get in an income statement, the less valuable the historical information is, according to him. I tend to agree with this. It's really difficult for a company to fake increasing sales, but net income can differ from one year to another in a major way, even though the company remains pretty much the same. The further down you get into an income statement or cash flow statement, the more noise there is in the data. So, the stock market values revenue growth. During what sort of time frame? Mr. Market values reliability over anything else. If revenues are increasing every year, he seems to think that that might continue into the future as well, and as a result, he assigns these companies a higher average PE multiple. So, it's not about how the revenue has increased as a percentage from 2012 to 2022 that he cares about, for example, but the number of times the revenue has increased during the last 10 years. If the revenue increases look steady like this, it has increased 10 out of 10 times during the last 10 years, the average PE for the company is 26.9, while if it has increased less than 5 times, it's just 16.0 on average. If you think that 26.9 versus 16 isn't that big of a deal, I sort of agree, and we'll get to something that Mr. Market cares much more about really soon. Next up is financials, and it's going to be a little bit underwhelming, I'm afraid. But hey, knowing what isn't important is important too. I've tried looking at measurements that signal financial stability in a company, such as the debt-to-equity ratio, the current ratio, net debt to operating income, and even something such as the interest coverage ratio. All of these yielded very questionable results. The only thing that I could find was that if a company sits on a net cash position, meaning that if there's anything left after you subtracted all its debt from its cash, it should be valued a little higher. But not by much. The average PE for companies with a net cash position is 19.9 versus 18.9 for those without that financial cushion. Then we have dividends. The stock market loves dividends, right? Dividend growth investing, anyone? Well, love would be too strong of a word to use, but among the 4,120 companies that currently pay a dividend or repurchase their shares, the average PE is 19.7. And for the 1,238 companies that don't, the average is 17.8. So, Mr. Market likes his dividends, but he isn't exactly obsessed with them. Profitability, on the other hand, is something that Mr. Market cares about a great deal. And just like with historical growth, he thinks the numbers higher up in the financial statements are of greater importance. The greatest discrepancies in valuation can be achieved when we compare companies with a high 5-year average gross margin versus those with low ones. With margins above 70%, the average company has a PE of 25.3, and with margins below 10%, the average company has a PE of 13.3. Is Mr. Market correct in thinking that companies with higher gross margins are better than those with lower ones? I would say yes, definitely. For one thing, if the economy is in for a downturn, companies with high gross margins will be better at surviving. They can endure lower prices and put pressure on competitors. Moreover, it may signal that a company has economies of scale. If it can increase its revenues, chances are that it can improve its net profits even further. One thing that surprised me when looking at profitability data was that Mr. Market doesn't seem to care about one of my favorite metrics, return on assets, much at all. No matter if you look at return on capital like Joel Greenblatt or the more traditionally used return on assets or equity. I think this may be a sign that the stock market is a little short-sighted, but I'd be curious to hear what you guys think. Before we get to the really juicy stuff, we have one final stop, and that is improvement in margins. Maybe the stock market likes to see a higher than usual profitability? In fact, Mr. Market values just the opposite. When I compared today's margins with an average of the margins a company had during 2017 to 2019, the results are quite clear. Mr. Market pays much less for companies that have higher margins than usual, and is willing to pay much more for those that have unusually low ones. I think this is a clear sign that the market believes in reversion to the mean. Everything that goes up must come down, and vice versa. Companies that have a 20 percentage point or higher operating margin than usual are valued at PE 10.6 on average, and those that have 5 percentage points lower operating margins are at PE 25.8. Always be careful with buying something that looks cheap during top margins. After looking at these historical numbers, I was a little bit disappointed. Is PE 25.8 versus 10.6 really the best we can do? It doesn't seem to explain some of the really high valuations that Mr. Market assigns to some companies. And maybe that is fair. But I decided to check one more thing before I gave up. And that was lucky. I took my crystal ball that I have hidden under my bed and looked into the future. Okay, no. I went to Ticker, and there I looked at forward estimates. These estimates come from financial analysts, investment firms, banks, or other financial institutions. And the stock market puts a lot of trust in these. I looked at the current earnings per share, EPS, and compared that with the EPS that analysts expect to see in 5 years, and got some really incredible numbers. When analysts think that a company can grow its EPS by 35% per year or more, the average valuation of such companies is 51.1. That's a really high multiple. One I'd never dream of paying for a company myself actually, but that's Mr. Market for you. On the opposite side of the spectrum, we have the companies that analysts believe will decrease their earnings by 15% or more per year. Those fetch an average PE multiple of 8. Here's the discrepancy that I was looking for, a metric that gives us almost a 7x difference in valuations. can we use this to decide where Mr. Market currently may be a little bit crazy? Yeah, perhaps. Let's first look at what Mr. Market thinks about different countries and industries. Mr. Market loves Switzerland and India right now. He thinks stocks from these countries are worth about 29 times their current earnings. Meanwhile, he really dislikes places like Turkey, Greece, and Pakistan. They're worth no more than 10 times earnings, maximum. But maybe this can be explained by the 6 factors that we looked at before. Perhaps companies in Switzerland and India just have better stats. I ran an OLS regression to see how all of these variables influenced one another, and of course, ultimately, the PE. It seems things like future EPS growth and gross margins only partially explains which countries Mr. Market is interested in. These are the statistically significant results I could find regarding countries. Poor Pakistan is valued at just 1/6 of India, even though they, according to the other variables we've looked at, are supposed to have basically the same valuations. Is there a good reason for this? Maybe. Geopolitical risk, transparency and accounting standards, and in some cases a more questionable attitude towards shareholder rights should account for something. But does it explain a 6-to-1 difference in valuation? Onwards to industries. Mr. Market loves companies within software and healthcare, but isn't as enthusiastic about those in oil and gas or marine. Now I did the same thing here. What if we account for the variables we've discussed earlier? Does that explain the higher valuations, or is it something else? These are the industries with a statistically significant effect on Mr. Market's PE valuations. The difference may not be as big as for countries, but this proves that Mr. Market cares a great deal about industries as well. Just like with countries, I'm a little bit skeptical about Mr. Market's assessment here. I think he's partially right, but perhaps overreacting a bit in both directions. But I'm not here to argue with Mr. Market. Let's pretend that he is correct, again, on average, and let's say that all of these 8 variables matter. If we combine all of them, we should be able to say what Mr. Market usually thinks that a company should be valued at, and compare that to what he actually thinks today. Then we simply sort the companies so that we find the ones with the greatest discounts. Here are the most undervalued companies currently according to this idea. I filtered out all companies below PE 7, by the way. Usually there's something strange going on there and I didn't want to include them in the list. This list should be used with a lot of care. I think it could be a good starting point for finding companies that are undervalued, but you must always do your own analysis before purchasing anything in the stock market. For you data crunchers out there, this is how I narrowed down the tens of thousands of publicly listed companies into the 5,358 ones used in this video. I did it all using the global screener on Ticker. And if you wish to be able to do similar comparisons, you can use my affiliate link in the description below, or just click here. For a serious value investor, a tool like this is indispensable, and I think that Ticker is the most bang for the buck out there. Cheers, guys!